Hello. Good evening, everyone. Good evening. Got on my Christmas sweater. I just came from a holiday party, but I am here to talk that tax. Let me know you can hear me. Good evening, family. Good evening. Welcome to Talk That Tax. I am your host, Nicole Day-Robinson, the owner of Day by Day Tax. Hopefully you can hear me. Make sure my volume is good. Good evening, everyone. I'll just give a little while. Let everyone come in. I don't know if this is an ugly Christmas sweater or if it's just a Christmas sweater, but I just came in from a holiday party, so I just want to say welcome to Talk That Tax, where we break down the tax code so that you can keep more of your hard-earned money. I am Nicole Day-Robinson, an enrolled agent certified by the IRS and the founder of Day by Day Tax with over 15 years of accounting and tax experience. I was a former IRS agent in the Small Business and Self-Employed Division, so I've seen it all. And my mission is here to just simplify taxes for both individuals and small business owners. So hopefully that everyone can hear me. I am going to get started in just a few, give a slight recap, and hopefully this makes me look at both of you because I am both on IG and YouTube. Let me know where you're watching from. Good evening, everyone. Good evening. Again, this is Talk That Tax with Day by Day Tax. And we are going to get started in just a few minutes. Live in the studio. Alrighty. As people are coming in, I just want to say good evening. Welcome again. I am Nicole Day-Robinson here with Day by Day Tax, and we are here live stream on Talk That Tax Tuesdays. We want to recap on what we talked about last week. Some of the major takeaways were your exemptions, making sure that you go in and you check your exemptions, making sure you haven't overextended yourself and haven't paid any taxes throughout the year. The main item is going in there, making sure that you are not set to exempt, that you're not set to 10, and that you have taken your fair share of tax. It's a couple of more pay periods. I believe it's maybe one more pay period, depending on when you get paid, if you get paid weekly, if you get paid bi-weekly, just making sure that you have changed your exemption so that you're actually giving your fair share of tax of what is due. My mission is here to just simplify taxes through the tax code for individuals and small business alike. Again, I have more than 15 years of accounting and tax and audit experience. I used to work for the Internal Revenue Service in the Small Business and Self-Employed Division. I currently hold an enrolled agent certification, which is the largest certification given by the IRS, where I can help with preparing returns, help with representation, help with also getting some of those missed deductions that you may miss because you haven't filed, making sure you're not scared to file, making sure that you are taking your time out to have a professional look at your taxes and making sure that you're getting all that you're supposed to be getting to lower your tax liability. Another recap from last week was also making sure that you're ready to file. So tonight we're going to talk about year-round tax planning, because April 15th, January to April 15th is tax filing season. It's not tax season. All year round is tax season. And I want to make sure that my listeners and my followers understand that tax planning is a year-round strategy that you should. I like to go with definitions and making sure that it's explained as simply as possible. That tax planning is a process of organizing your finances throughout the year to minimize your tax liability and to maximize your deductions and credits. So I want to make sure that you are definitely taking advantage and making sure that you are prepared throughout the year and not just when it's time to get all your documents together for the preparer or when you're going to self-prepare, that you're not looking for little things as you're preparing and waiting until the last minute. I want you to be prepared throughout the year so that you avoid surprises. You maximize your savings, because if you are planning throughout the year, your decision-making changes. Your decision-making will always prepare you to be thinking about how this is going to be a benefit when it's time to file my taxes, and not so much as a benefit right now during the planning period, but when it's time to actually doing the filing season, which is that January to April 15 timeframe, that you are actually prepared to file your taxes. Some of the other benefits of being organized is better financial decisions, making sure that you are using your resources and allocating them properly throughout the different areas, through retirement, your contribution. Definitely a bonus. If your employer is matching with, I know what the government is the thrift saving plans, which is also a retirement plan. But if your agency and employer is matching, you should at least be contributing to your retirement up to the match. I know sometimes that different issues may occur that you may not have enough funds to actually suffice for the everyday expenses, but at least doing the match, you should definitely be doing that. Some examples of just poor planning and good planning. Poor planning is waiting until April. That's why I'm definitely really a sticker with tax planning and not just filing season. Tax planning is year round. So waiting until April to gather all your documents and just want your accountant or your tax preparer to make a miracle is not fair to you. It's not fair to the preparer. To making sure that they're actually giving your tax return, because your individual taxes are not like anyone else's. So your situation is different. So you want to make sure that you give yourself and your preparer enough information, enough of the documents in a timely manner so that they can make good decisions for you throughout your tax filing season. Again, another positive for the tax planning is what we talked about last week, is making sure that those exemptions are at the number that makes sure that you're paying your fair share of tax. Again, you should not be making $65,000 a year and only paying $1,500 in taxes throughout that year. That is not sufficient. Definitely, you can do a tax calculator on irs.gov and making sure that you understand what you are supposed to be giving based on your income. And that's, again, irs.gov. It's a great tool. It's called a tax calculator. You can just Google a tax calculator and it will definitely give you the tools to make sure that you are prepared to pay the fair share of tax. I know sometimes you may want to play with your exemptions, take more, take less. throughout the year, but not everyone is responsible and goes back and changes it. So I want to make sure that you go back and you change those exemptions if you do mess with them, because you don't want to fall into the lines of having to owe because you didn't pay your fair share. So prevent underpayment. That's what that is. Underpayment is having your exemption so high that you do not pay your fair share. So that means you underpay your taxes. And come April 15th, when your tax liability, if you have one, is due, you will have to pay what you did not pay throughout the year. So proper planning will prevent you having to pay additional penalties and interest. Avoid overpaying. Just know that overpaying is giving the government an interest-free loan. Because if you overpay and you get a refund, it's no interest. You only are going to get what you overpaid. So definitely use that tax calculator to make sure that you are not paying too much. And when you're paying too much, that you're not getting any interest on not paying that. So you don't want to do that. And that loan is interest free up until the date that you file. So if you don't even file April 15th and you may file an extension and file at a later date, again, that's interest free loan that you have given the government of paying too much taxes. You gotta, so examples of different reasons to adjust your withholdings. Say you got a raise. So you got a raise and you want to make sure, if that raise is an exceptional amount, or if you got say about $5,000 raise, you may want to go and adjust your exemptions to match that increase. So say if it's like an extra $10 that you want to take out to make sure that you are sufficient with the additional income, because that means that you were making $35,000 a year, now you're making $40,000 a year. I wouldn't say that you're in a different tax bracket, but you will have a larger tax liability that you need to pay to make sure that your exemptions are set to the amount that. So just use a withholdings estimator. That's the calculator again. Make sure you use that. And make sure you put the new income. So if you got a raise, put the new income in there. And that could change throughout the year depending on if you get raises. So I just want you to make sure that you check your withholdings. Also, major life changes. Say you bought a house. Say you had a child. Say you got married. So now your income has changed. Getting married, your income, you're combining income. So income increases. Say you had a child, you will have additional deductions. You're adding additional expenses, so you can lower your exemptions. You can increase your exemptions because you have additional expenses to offset it. Say you have a second job. If you have a second job, you may not want to be taking the max of those exemptions on both jobs, or to making sure that you're paying your fair share. So make sure when you put it in the withholding estimator, just join the two jobs together to make sure that you're taking the right amount of taxes. So taking advantage of the different accounts, like again, your 401k, making sure that you're matching contributions to your church, make sure that you're giving those. Your health savings account is a tax benefit. Contributions are tax deductible. So what you put into that health savings account, you can deduct on your taxes. A 529 educational plan is a tax deduction. And later when you want to use those funds, they can be used for education expenses, for tuition and books and things like that as your child may get older. So just making sure that you contribute regularly throughout the year is good tax planning, and not trying to scramble and get records together and trying to donate in different things. I do know sometimes like doing purges, also for your non-cash contributions. These are items that may be in your house that you're no longer using, that you can donate them to different nonprofit associations, and making sure that you give those to different areas so that you can have those deductions. So making sure that you pay attention to that. And again, buying a house, having a child, marriage, those are major life changes major life changes that you want to pay attention to make sure that you are changing your exemptions accordingly, to making sure that you're not paying more than what you should be paying. So, for instance, if you're having a child, you want to make sure you update your W-4, because having a child is additional allowances, and and you should be reducing your withholdings, because at that point you would need additional income. So tax planning is more than just about numbers. It's about adapting different strategies based on your particular situation. So you do not want to try to do an end all be all and not make sure that you are planning accordingly for tax things. So some questions that you should ask yourself is, how often should I be adjusting my withholdings? It depends. You should be adjusting your withholdings according to how your life changes. If nothing changed in your life, then you should not need to be changing your withholdings. You should be leaving them as they are. Another one, making sure that you're contributing to your 401k. If your employer has a match, you should at a minimum be putting in the match. The records that you should keep for life-changing events, like having a child, making sure you have the social security number so that you're able to include it on your tax return. If you're buying a house, making sure you have your 1098 statement so that there's any mortgage interest or taxes that you need to deduct. So just making sure that you keep those records and take advantage of these opportunities throughout the year. Some of additional tax planning strategies: if you own a business, like make sure that as an entrepreneur that you are reviewing your bank statements on a quarterly basis, to making sure that you're tracking what you're spending your money on, tracking what income has come in, making sure you're checking all those avenues of income, making sure where you accept income. Are you accepting cash? Are you accepting Zelle? Are you accepting Cash App? Are you accepting different payments that go directly into your bank account? So making sure on a quarterly basis that you check your bank statements to make sure that you are tracking the income that you receive as it relates to entrepreneur income. Making sure that you are paying any estimated taxes. This is another basis on tax planning. These are paid quarterly. Put it in that estimated tax calculator on irs.gov. I made $3,000 in the first quarter. See how much tax you would owe based on that income, and pay that estimated tax. Don't pay any more, don't pay any less, but make sure that you are staying up on those quarterly withholdings. Quarterly taxes payments are made to the IRS just to cover the income. The dates for that, the due dates for 2025 are April 15th, June 17th, September 16th, and then January 15th for 2026. So for all the estimated taxes that you have paid for the current year, the last payment is due in January of 2025. Self-employment tax, just make sure that estimated tax, because you are self-employed, that you actually pay those expenses. So maximizing your expenses, tax planning, maximizing for small businesses. Where are you working? Are you working in your home? Is there a designated area that you work out of your house? So you should be thinking of different deductions and benefits throughout the year, making sure that you're making that area a business area that you're able to include on your taxes. Making sure if you are having meals and talking to people, that you are keeping track and having a log of the conversations that you have about business. You want to make sure that you keep the good records throughout the year. You don't want to be scrambling coming December trying to track all the expenses for the year. Excuse me. The best practice is to check these records quarterly. So every quarter, so you got January, February, March, that's a quarter. April, May, June, that's a quarter. July, August, September, that's a quarter. October, November, December, that's another quarter. So there should be 4 quarters throughout the year where you are tracking, reviewing your bank statements, reviewing your records, to making sure that you are tracking all of these benefits that you should have as a self-employed person. Making sure that you are using IRS resources. So publication 535, it provides a detailed guide of deductible business expenses. IRS tells you what you can do. You don't have to try and figure it out. They tell you what you can do. They tell you what's allowable. They let you know that if you are operating in a business, that these deductions are what you can hold. You should have that listing in your financial record so that you are keeping track of anything that you spend that's business related. You're like, oh yeah, I did that. That's for my business. Oh yeah, I did that. That's for my business. Making sure that you are staying on top of, then going back in those quarterly reviews, making sure you're going in there with highlighters, tracking what the type of expense is to making sure that you're not missing anything. So it helps you just be prepared throughout the year. Additional breakdown for my small business people, being that is a second job, you should be making sure that you are adjusting your withholdings. So we're going back to those exemptions. Having a business is definitely like having a second job. So you should adjust your exemptions or withholdings according to what you will be having as an expense, according to the receipts that you would have in the business, in addition to your regular W-2 earnings. So I just want to make sure that you are aware of that. So I know that I've given a lot of information, so I'm just going to go back through the recap of year-round tax planning. So again, year-round tax planning, we just want to make sure that it's the process of organizing your finances throughout the year to minimize your tax liability. That's all we want to do. We want to minimize our taxable liability. And by having adequate tax planning, it avoids surprises. It minimizes a tax bill and penalties and interest because you're prepared throughout the year. It maximizes your savings because you're contributing to the employer 401k, the federal employee TSP, the 529 plan, making sure that you're paying attention to things that change in your life. If you got a raise, changing your withholdings. If you got a bonus, changing your withholdings to make sure you justify that is extra income. So it's not the same as it was last year. So making sure that you stay in abroad with that. Hi, Michelle. Thanks for joining, love. Examples of poor tax planning would be waiting until April to gather all your documents and then realizing you didn't pay enough estimated taxes. That's poor tax planning. Poor tax planning is putting all the information into the system, realizing that you owe, and then trying to get it prepared to help you out and save. Poor tax planning. You don't want to wait until the last minute. Wait until the last minute is going to cost you. It's going to cost you penalties and interest because at that point you're going to be like, oh, I owe. I'm not going to file. Now you're becoming a non-filer. Now you're becoming non-compliant with different things that come from that. Hi, Shell. Thanks for joining me, hon. Good tax planning is tracking your expenses. Monthly, you should be tracking them, but sometimes monthly can get away. So at a minimum, quarterly, you should be tracking your expenses. A good way to exercise is monthly, but not everybody can do monthly. So we don't want to try to pressure you into doing monthly, but at least at a minimum quarterly. Adjusting your withholdings and contributing to tax advantages accounts. And again, those accounts, as I previously, is your 401k, your health spending plan, your 529 plan, are definitely advantages that you should be taking. Again, some of those life changes that you should be paying attention to is marriage, having a child, buying a house. Those are major changes that you should be paying attention to because those adjustments change your income, they change your expenses, and they affect your taxable situation. So you want to make sure you pay attention to that. Definitely with the new job, you definitely want to pay attention to if your income is increasing because you want to make sure that you're paying your fair share. Additional things that I wanted to discuss is with the small business owners, I want to make sure that as you're planning throughout the tax season, that you are going to the IRS resources and making sure that you are paying attention to those resources. There are, depending on your business, the IRS.gov has audit technique guides. And using these audit technique guides, they basically tell you everything about your business that the IRS would look like just in case of an audit, helping you prepare your taxes, knowing what type of expenses that you can deduct for that type of business, because every business is not all inclusive, and it's not meaning that every business is the same. So I just want to make sure that you are doing that. Making sure that you're just being proactive and organized with maximizing these opportunities. Make sure to consult an expert. I have 15-minute consultations that I will do with anyone, just to see what your tax situation is and see what your tax needs are. If you may have any questions specific to your situation, those 15 minutes are yours, and I will give you all that you would need to be successful. So I just wanted to make sure that you know that. Another key point is I wanted to make sure that you understand about tax planning is year round. Tax filing is the documents for the previous year that you would get from January 1st to, they're supposed to be sent to you by January 31st. Filing season usually begins, e-filing usually begins mid-February, where the IRS will start accepting e-filing returns. And then once you have those records, that's filing season from February all the way to April 15th. If you do decide to file an extension, you do get 6 months from April 15th to file your return to October 15th. A reminder also that if you file an extension, it is an extension just to file the return. You still should use the estimated tax calculator of how much taxes do you owe, because they are still due on April 15th. So just want to make sure that that is what you always remember. So understanding withholdings, want to make sure that you understand what withholdings are, knowing that it is estimated tax payments, but you need to make sure that you're paying the fair share of estimated tax payments. So that was mainly what I wanted to discuss today, making sure you have good record keeping, making sure that you are planning for taxes all year long. Some key things for to preparing you for the 2025 tax season. Just want to make sure that we have that. So some of the new changes that are coming up for the 2025 tax season. I just want to make sure that I hit those. So before January comes, just some things that you need to know. Filing matters. Make sure that you file. Max out your credits and your contributions to the different avenues. Stay on top of your record keeping throughout the year. Be aware of the new tax changes for each year, and always remember that the deadline is April 15th for filing. We did have one year where they extended it, but just want to make sure that you are aware that taxes are due April 15th. There will be for 2025 an increase to the standard deduction. Understand the standard deduction, it will go from $15,000 for single filers and up to $30,000 for married couples filing jointly. These adjustments are inflated and can significantly impact your taxable income. So make sure you review all of your records for making sure that you are aware of those new standard deductions, because if the standard deduction is higher than your Schedule A itemized deductions, which is your home mortgage interest, your state income taxes withholding, your real estate taxes, your charitable contributions, cash and non-cash, and any unreimbursed employee expenses that you may have. If that amount is not greater than the standard deduction, then you may not get the benefits of that. So you may want to increase some of those contributions just so that you get the benefit of having that Schedule A. So that is some of the main things for that. I just want to make sure that I don't have any questions from anyone, but that is all of the Talk That Tax that I have for you tonight. I just want to make sure that you are prepared, and remembering that tax planning is throughout the year. Again, I am Nicole Day-Robinson, the owner and founder of Day by Day Tax. And I just wanted to make sure that you guys are aware of this information. I appreciate you tuning in. I'm here to help small business, self-employed, aspiring entrepreneurs, and individual taxpayers to simplify your taxes. Follow me on Instagram and Facebook at Day by Day Tax for any tips and updates. Subscribe to Talk That Tax on YouTube. And again, Day by Day is here to guide you and help you in any way to simplify your taxes. I appreciate you all checking me out in any way that I can help. Again, remember, I do 15-minute free consultation. Please DM me. Go to my website at daybydaytax.com for additional information on how to reach me. And until next time, I'll see you guys later. Bye.